the biggest risk going forward, as I see it, is stagflation, right? So basically, where countries are trying to maintain positive GDP growth and trying to manage high inflation, and having, say, energy shortages. I think energy shortages are going to be one of the keys. If we have a really tough decade ahead, I saw a data point that the S&P 500 had one of its biggest, down moves to start a year in history. Even though so far it's a pretty
Wow.
small move, but it's been so compressed to the very beginning of the year. The whole world is dealing with these negative real rates. So their bonds and their cash are yielding below the prevailing inflation rate. So a lot of people don't want to use money or use currency as a store of value. And instead, one of the things that they use is large cap US companies with smooth growth. And they just kind of say, you know what, I'm just going to pilot everything into that. I'm going to buy index funds. I'm just going to shove as much money I can into equities because I'd rather store value there than in a bank account that yields, 0.5% while inflation is 7%. You can either have a significant drop or you can just go sideways for years, right? We had periods of time where equity markets just chop sideways, volatile pattern for years, because eventually you pull so much capital in, you have to ask, where is the marginal buyer? If U.S. households already have record high allocation to equities, who's going to be a further buyer of equities? If foreigners are already very overweight U.S. markets, who's going to be that marginal buyer? Now, it doesn't mean that this is the absolute top. You can always kind of find another, you can always scrape the bottom of the barrel and find another pool of capital somewhere that's a little underallocated and get, even higher. Basically, for example, in say 1998, if you're talking about how high valuations were, well, it's like, another, it was going to run even higher over the next 2 years till 2000, right? So it's very hard to call a top, but it's more like just pointing out that conditions are getting quite risky. And basically, for whatever reason, the US equity market became less attractive to global investors. It could just because valuations become so heavy and they run out of marginal buyers. It could be because we do crackdowns on our big, tech companies. We want to say kind of go after them for antitrust issues. It could be just all sorts of reasons like that. If capital starts flowing out of the U.S. while we're also running a trade deficit, you can have a pretty sharp down move in the dollar and a sharp down move in U.S. equities compared to the rest of the world. Well, starting in February 2021, we saw a lot of the unprofitable hyper growth stocks. They peaked as a basket and started to roll over for about 11 months now, while the broader indices kept grinding up. So the mega caps kept doing well, while the hyper growth stocks started to roll over. And what we saw since the beginning of this year is that some of those really big ones started to roll over as well and show weakness. And it's interesting because value stocks held up better. So some of the less overvalued, dividend paying stocks, slower growth companies, they did pretty well. And we actually saw emerging markets hold up a lot better in this down move than U.S. stocks. So basically, we did see somewhat of a pullout of capital, and so this was in some cases an unusual market move, and it's somewhat similar to how it looked in the really early 2000s after the dot-com bubble started to unwind. And it's too early to say if that's going to be part of a bigger move, but it is I think a lot of macro people catches their attention when you see, for example, Brazilian stocks go up on a day where the S&P 500 has a massive down move. That's an unusual risk pattern that is noteworthy. Dollarized countries that are not the United States have challenges because they're operating for them it's a hard currency because they can't print it, right? So they're
Hmm.
for them it's this hard currency, and if the U.S. stimulates, right? So if the U.S. hands out stimulus checks to all its citizens, the dollar gets devalued, but El Salvadorians don't benefit from that. Other than the fact that they might get some increased remittances from their American relatives, but other than that, they have no mechanism to benefit from those stimulus, and so they get devalued. And at the same time, they have less kind of ability to manage their own currency supply, and so basically adopting Bitcoin as legal tender can increase their money supply because it brings in another type of currency they can work with. And it also gives us El Salvadorans a chance to save in a currency that, over the long run, is probably expected to, hold its value better than the dollar. And so they don't keep getting their savings devalued by Americans choosing to stimulate themselves. And it's just, whether an emerging market is dollarized or whether they're running their own currency, but they have dollar-based debts, they all get impacted by what happens both in terms of U.S. policy and in terms of foreign capital flows into and out of the U.S. So it basically it's a, if this was an engineering system, it would be considered a rather sloppy and harmful system for a lot of participants. All the major bull markets, so 2011, 2013, 2016, 2017, and 2020 into 2021, those were rising PMI environments, purchasing managers indices, which is a measure of whether an economy is the growth is accelerating or decelerating. And so a PMI averages around 50, and if it's above 50, it means it's expanding. And if it's the higher above 50 it is, the more rapidly it's expanding. And so when you have a declining PMI, it can still be that your economy is growing, but it's growing at a slower rate. And so generally, all those bull markets occur during accelerating economic growth. Whereas the bear markets are generally, kind of flat to decelerating growth in the US and generally kind of the Western world in general. And so Bitcoin has been a traditionally risk-on asset for a lot of its period. Now, that correlation is a lot different if you look at, say, emerging markets, right? So if you look at Brazilian equities or Turkish equities or Chinese equities, you'll have a lot less positive correlation with Bitcoin. So for them, Bitcoin is a diversifier in many cases.
Okay,
It's
yeah.
just that, especially for American investors, it's not necessarily been this hedge or this uncorrelated asset. It's been this correlated asset. But as it goes through these cycles, because of the qualities it has, it builds this value over time, at least historically. And so it's been positively correlated but stronger. The challenge that central banks face around the world is death by ice or fire, right? So do you want things to unravel in a deflationary collapse, or do you want to keep stoking the fire of inflation by printing currency units to maintain, the status quo? And so in history, the vast majority of fiat currency regimes die by fire, not by ice. When a push comes to shove, they print. Um, and it's one of those things where if they don't print, ironically, you still get inflation. It's like a different route, right? Basically, you would have a deflationary collapse until the currency is useless, and then it hyperinflates, right? So it all kind of leads in the end towards weaker currency, and there's just different paths to get there and different timelines to get there. My base case is I view each market separately. The biggest risk going forward, as I see it, is stagflation, right? So basically, where countries are trying to maintain positive GDP growth and trying to manage high inflation, and having, say, energy shortages. I think energy shortages are going to be one of the keys. If we have a really tough decade ahead, I think a lot of it's going to be tied into whether or not we have abundant energy or not. And so if we have energy scarcities and if we have kind of these policies of energy run up into physical reality, I think you can get some pretty bad outcomes. And so I would watch energy markets pretty closely.